The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us for another conversation with Bill Chen in our series on investing in real estate. Also great to have my co-host, Elliot Turner, with us. Elliot will kick off the conversation with Bill, and I know it's going to be a good one. There's some pertinent things to talk about and some more long-term evergreen insights into real estate investing in the public markets. So, Elliot, over to you.
Great. Thanks, John, and welcome back, Bill. Really excited to have you on here again. Hope everyone out there got the opportunity to listen to our first episode. Covered very wide-ranging the real estate landscape in public markets and the opportunities. And today, we're planning to dive a lot deeper into some of the specific areas. But first, we are called This Week in Intelligent Investing. I love pointing that out to people. And there's something extremely timely in the REIT space, in the real estate space that's playing out as we speak. And specifically, I'm talking about Starwood's S-REIT and the gating of redemptions, kind of similar to what happened with Blackstone's B-REIT. So, Bill, curious your thoughts on what's going on here. Is this a sign of like some deeper future troubles, or is this some unique issues with Starwood's S-REIT? How do you think about this?
Okay. Well, I think, Elliot, it'd be good to provide a little bit of context on what is S-REIT, what is B-REIT, and what has happened. I think I think our listeners will benefit from that. So this is my way of understanding of describing the situation. So S-REIT, which is Starwood Real Estate Income Trust, and then there's B-REIT, which is Blackstone Real Estate Income Trust. These are what is known as non-traded REITs, right? So there's public traded REITs like Camden, Mid-America, Prologis. You could go into your brokerage, you could buy it. The transaction fees are pennies per share, and they're liquid, right? Which is like a whole separate conversation on liquidity and whether liquidity deserves a premium and discount. But what has happened with S-REIT and B-REIT is that they are non-traded REITs that has a unique quirk in that they allow up to 2% redemption per month. And I believe both of them allow 5% per quarter in aggregate. So people like Cliff Asness have kind of talked a lot about, he calls it volatility laundering, and how Blackstone and, Starwood, all these, real estate private equity is a way for allocators to allocate capital to these vehicles. And then you don't have to look at a mark. They give you a NAV estimate. And which is, anyone who's in the investing business have witnessed the rise of the alts, right? The rise of the alternative managers like Blackstone, KKR, and they gather a lot of assets over the years. Now, most of those capital are allocated to kind of 5-10-year holding periods where you are not allowed to redeem. There is no liquidity. There is no redemption window. These vehicles naturally has an investment period, and then they unwind. Now, what's unique about S-REIT and B-REIT is that 2% per month redemption. And so there was a Wall Street Journal article on May 20th that talks about, the title is "A 10 billion real estate fund is bleeding cash and running out of options." And it's specifically talking about S-REIT. And mentioned it's got three choices, none of them are appealing. So some key stats is that there was about $1.5 billion of withdrawal requests in Q1 of this year, but they only redeemed $500 million. And since the start, since the Fed started raising interest rate, you could looking at a chart right now. Redemption typically were below $100 million per quarter, and then you really see the redemption for SRE spike up to about 350 million in Q3 of 2022, and then reach almost 800 millions in Q4 2022. And then it's been consistently between $500 million to almost $700 million in the quarters following that. At the same time, inflows, SREIT fundraising has absolutely dried up. I mean, SREIT used to fundraise more than $500 million per month. Even the first half of 2022. But once the Fed started raising rates, you could see. I'm looking at the chart from May 20th, and you could see the new fundraising drop. It's literally like a curve that just slopes downward. To more recently, where monthly fundraising is between like $10 to $15 million per quarter. So if you could think of a bucket where it used to be that you would have, on a monthly basis, you may have $500 to $750 million of capital coming in to help SREIT, Starwood REIT grow. And fast forward, that's in the beginning of 2022. Fast forward to today, that capital coming in, it had dropped down to $10-15 million. But the outflow has grown from maybe, call it like I'm eyeballing this, probably, call it like $47 million in Q1 of 2022 to now the recourse is actually for $1.5 billion, but they only redeem people for $513 million. And here's another stat, which is that at the end of 2022, there were $2.2 billion of liquidity, which consists of cash, marketable securities, and bank line of credit. At the end of Q1, there's only $752 million at the end of April. So that's not just cash. That also includes the bank line of credit. And then within 3 days of that article appearing in the Wall Street Journal, we got on May 23rd, Wall Street Journal reporting in that what they have done is they have reduced the redemption from 2% of net asset value to 0.33% each month. And then they're limiting it to 1% of NAV per quarter. And that on a quarterly basis, that used to be 5% of the NAV. And and SREIT has also voluntarily reduced their management fees from, I believe, 1.25% to 1%. So this is kind of a bit of a moment in the in the real estate world where the gates are up. These non-traded REITs are significantly. I mean, SREIT, like we don't BREIT hasn't come out and put any of these gates down, but SREIT has come out and essentially cut the monthly redemption by roughly the quarterly redemption by 80%, and monthly redemption by 5-6, right? So very, very large reduction in investors' ability to withdraw that capital. So that is the backdrop of what has happened in this week.
So let me ask you this. This is a problem that literally can't happen in public REITs in this way, right? There's no redemptions. They're kind of fixed in terms of the amount of capital they deploy. Do you think it's a structural problem with these private REITs? And relatedly, I asked you a lot of questions last time, kind of dancing around but suggesting my skepticism about public REIT NAVs. But do you think there are really perverse incentives with these private REITs and what they say their NAV actually is?
So I will state the some facts, right? And the management. So the management fees are charged as a X percent of the NAV. So so I think that reasonable people could argue that if if your NAV is higher and you're charging 1.25% on a higher NAV, there would be an incentive to mark the NAV higher, right? That just kind of makes common sense. Um, and I think that there was also, it's interesting because a lot of the public REITs, you can look at the NAREIT All Equity Index. You could look at a ETF like, VNQ, which is the Vanguard REIT ETF. Uh, the index and the ETF have very large drawdowns in 2022, and didn't recover as much as the S&P 500. But you know, a lot of the executives at Blackstone and Starwood are out there publicly touting that they perform better than the public REITs. They were pointing to, hey, look at the drawdowns on public REITs, but we're fine. Look at our NAV. I think if I remember correctly, the performance of BRE is that they had an 8% total return in 2022, when the NAREIT were down in somewhere in the mid 20s and total, low to mid 20s in total return. And then SRE essentially has similar kind of total return metrics as BRE. So I think that if your NAV is higher, you get to charge a higher amount of management fees, which will benefit both vehicles. I don't want to go so far to say that they're actually doing it. I mean, I think there's certainly incentives for them to do so, and I think that the kind of being able to tell a story where you say that we're outperforming the public REITs. And they also cited that they just have better exposure. They didn't, particularly BRE was saying that they didn't have any office exposure. So they didn't, it didn't impact them. They have more exposure to apartments, to data centers, to warehouses. And it's also, they kind of credit to the allocation of the asset type, and they credit it to like things that they're kind of own special sauce. But I would say that like any reasonable person with common sense could probably look at it and come up with their own opinion on, hey, there's like clearly a lot of incentive to mark the NAV, high, and then like they're selling this. The big selling point of an alt is you don't have to deal with the volatility. Now, I think what's interesting is that I think that if you are locked up like a pension fund or an endowment, I think that it is lesser of an issue because there isn't like a force mechanism for you to potentially experience accretion or dilution. And just like, allow me to explain, right? So by having these 2% monthly redemptions windows, and by holding the NAVs at the NAV that they claim these assets are worth, and I've done some kind of high level work where I believe that BREIT is in essence marking their portfolio at like a 4.8%, like a high force cap rate. And then S-REIT is in essence marking their portfolio at like a 4.3 cap rate. Like call it like these are generally the neighborhood, right? So what's happening is every time that someone asks for their money back, right? There's in essence, there's a mechanism where they're buying back, and they call it buyback, right? They call it buyback.
Okay, Bill. So we had a little technical issue, but why don't you go ahead, please, now?
Okay. So I believe where I left off last was walking through the buyback feature and the general gist was that that both vehicles allowed 2% monthly redemption, up to 5% quarterly. And we kind of briefly talked through that S3, by my estimate, was valued at a 4.3 low force cap rate, and then B-REIT was valued at a high force cap rate. And just my personal opinion that in today's more elevated environment, it appears that any sorts of real estate asset with a four handle in front of it is hard to justify. By comparison, Mid America and Camden, the two largest Sunbelt multifamily, which has a lot of similar asset type and geographic exposure, and also supply demand dynamics, they trade at closer to a 7% cap rate in the public markets. So there's just a really big delta between what S-REIT and B-REIT is marking their their kind of portfolio at versus what the publics are trading at, and also what private deals are generally transacting at. For multifamily, what we're seeing is most deals are done with a five handle cap rate. A lot of it in the mid 5% cap rate is what we're seeing private deals being done at. So next step is, in a way, this functions like a share buyback mechanism, but instead of buying back shares at today's value, because they marked it at a 4.3 to call a 4.8 cap rate, by my estimate, in essence, they're kind of buying back shares from the LPs at a 2021 year-end price, which if you kind of think about, if they're they're basically forced to rebuy their own portfolio at what I personally believe is a very unattractive price. And that, I believe, could have consequences to people who don't redeem who decide to stay in, because you wind up owning more and more of these assets at a four handle cap rate. These are my personal opinions. I'm just not a big fan of owning more assets and buying more assets at a 4.3 to 4.8% cap rate as of today.
So yeah, I mean, isn't that a massive problem where the very existence of the redemption gating, and it's a wake-up call to people who are sitting there passively holding these things, thinking they're holding something, that's fairly stable, marks won't move very much from one month to the next. And suddenly you're like, whoa, actually, today I could buy Mid-America for like over 3 points of yield pickup, and have daily liquidity. Now this thing's gated. This is not what I signed up for. Like, let me try to get out as quickly as I can. So is it possible that these kinds of players can become forced sellers into the market? Or do they have to like drastically restrike their NAV, dish out some really tough losses to everyone in there, and kind of regroup from there?
So, in terms of like forced selling, I think that by putting up by S-REITs, putting up the gates that they have by significantly reducing redemption to 1% on a quarterly basis, that solves a liquidity issue for them in the short term, right? Because going from 5% quarterly, which is 20% annually, to 1% quarterly, 4% annually, that buys them time, which allows them to wait a little longer, potentially wait for an environment where the Fed do cut, where the Fed may potentially cut rates in the future. And it would likely be better for them to sell into an environment where the Fed rate is a lot lower than what it is today, right? So from a kind of triggering a for sale, a ton of for sale activity in S-REIT and B-REIT, I think that the reduction in the redemption definitely solves some of that problem, right? It doesn't solve all their problems. Now, in terms of like marking down the NAV, I mean, I personally don't agree with that NAV. There's been a lot of real estate professionals that I talk with who don't agree with that NAV either. And this is a topic that's been talked about within real estate circles for the past year and a half after the Fed started hiking rates. I don't know what the mechanism will be for them to write that NAV down. And as I'm thinking out loud, I think that my gut tells me that they'll be reluctant to mark it down, because if they mark it down and use different cap rate assumptions, it probably means that they may have to port some of those cap rate assumptions to some of their other vehicles, right? So this is just kind of me thinking out loud. I certainly don't agree with it now. But will they actually do something to mark it down? That I'm not sure about. I think something would have to. I don't think that they would do it on their own, but like if something does happen, it would be forced upon them, right? Maybe. I don't know if any of the regulatory bodies will like come in and force them to do it. I think that the longer that rates stay higher, there's more of a pressing argument that they should mark it down. But then it could very well. There is a scenario where if the Fed do cut rates in the near future, and all of a sudden, they could kind of claim that, hey, all this worry was like a big nothing burger, right? And that is like the advantage of investing in alts and privates, is that you don't have to worry about that. But I think that from we take a step back. I think that it's my personal opinion that in the interest of raising as much capital as they can, as quickly as they can, I think that by adding these redemption liquidity windows that targets kind of high net worth individuals and family offices, I think that they kind of made a strategic error in because the power of a private investment is that you're stuck in it, right? Like you're stuck in it. There's nothing you could do. And by offering this private alt, but like also allowing up to 20% redemption per year, they kind of created like this weak link in their product. So it's just super interesting for me to think about and track. This is a topic that I've been following very, very closely. And also in terms of the size, S-REIT is about $10 billion in NAV, and then B-REIT is, I believe, 60, 70. I mean, there's these NAV numbers are kind of 60, 70 billion. So these NAV numbers are dynamic. Yeah, there's a good chunk of outflow ongoing right now. And, is it big enough to be systemically important? Probably not. I don't think that the S REIT and B REIT will impact the rest of the endowment and pension and institutional investments. I don't, because the other vehicles just have much longer and more rigid lockup structures, right? That they're not forced. There's no liquidity terms that will force them to have to sell assets to raise capital to meet redemption. So I don't think this necessarily will cause their other business to to suffer. I mean, from a brand perspective, I think that I think a reasonable person could definitely make the argument that the Starwood brand and Blackstone brand is a little bit tarnished by this. I think you could make an argument for it. Like, I think what allow Blackstone and Starwood to grow so quickly is because a financial advisor could tell their client, "Hey, you're investing with Blackstone, you're investing with Starwood. These are the blue chip managers, right?" And having to put up gates and significantly reduce redemption, I think will definitely take some of the shine off these names. And maybe like I would just add another wrinkle to this. I spent a lot of time thinking through, like, why were these vehicles able to grow so quickly? And one of the things that I've heard from people is that if you have a financial advisor for high net worth or family office, um, I think the way that they are compensated, like if you're just recommending an ETF to your client, there's very little fees to be earned by it. But I believe that, and I'm not 100% sure on this, believe that the fees that BREIT and SREIT pay to financial advisors are significantly higher than what a recommendation in a passive ETF would be. So there's a lot of financial incentives within the broker distribution layer for them to promote these products. I mean, I know Blackstone has a incredible name within the institutional investor space, but it's kind of bewildering to see how quickly BREIT has grown from zero to $70 million of NAV in a span of a few years.
So yeah, let's think about that for a second and use it as part of the pivot here. But I'm going to say something maybe a little half baked, but like presumably those flows that went to BREIT and SREIT traditionally could have and would have gone into public equity REITs. And perhaps it was a really big headwind to the flows that could have supported some of these public equity stock valuations a little better. There's an opportunity to effectively arbitrage, buy Middle America for over 7% yield versus the mid fours for these privately traded ones. And sure, you're going to have to deal with some public day-to-day marks, but at least you can trust that it's not crap that you're dealing with. And, you could say all you want about Mr. Market, but, some days he's near, some days he's dear, some days not so much, but at least it is real. It's something that you see and it's something that you could act on. And there are no redemption gates in that sense. You could sell stupidly or you could sell smartly, but like,
Hello?
Yeah. One of the things that I'd be curious to hear your perspective on, there was a quote you had in the last podcast that I absolutely loved. It was, I asked you about the landscape right now, which were your favorite areas within the REITs. And he said, it's like a buffet right now. Everything looks great. So I'm really curious, starting at the high level and thinking about portfolio construction, how do you think about portfolio construction? How do you think about which areas you want to allocate to, what portion to give it to? And how do you think about concentration within each area? Or do you pursue like just a basket and try to catch kind of the beta of the whole space?
Got you. Well, Elliot, I think that's a great question. I think that I will start with it's definitely my personal opinion that you could get much better uh, forward returns in the public markets right now in the public REIT space. And I would tend to agree with you that yes, like you're likely right that a lot of that capital that would have flown into the public REITs likely did go into SREIT and BREIT. I mean, it is 70, it is like almost $100 million of capital that that flow into B-REIT, S-REIT, and there's a few other high-profile ones that we didn't talk about today. So I think you're absolutely right on that. And I think that in a way, that capital that got locked up there, like, wasn't there to catch the fallen knife in the public side. So definitely agree with your take there. And then in terms of like, where am I finding? How do I think about portfolio construction? Like, how are we, positioned? By the way, just so that like we have a sense of like the difference in like the NAV marks, right? You could take a blue chip name like Mid American Apartments at the peak in December of 2021. It was trading at essentially $230 a share. You could buy that. You could buy Mid America at $128 a share today. And in that time, the net operating income has gone up about 20% since year end 2021. So not only has the stock price fallen from 230 to 128, the NOI has actually grown roughly 20% from year end 2021. So you literally, every at the end of 21, it was trading probably in the kind of like high threes, low fours cap rate, right? And today you could buy it around 7. A lot of it is due to the decrease in price, but a lot of it is also due to the increase in NOI during that time. Now on to portfolio construction allocation. I would say my preference is to allocate 70-80% to kind of blue chip, low leverage REITs like a Mid America and Camden. And if we do wind up owning some warehouse exposure to the likes of Prologis, right? But we don't, we don't own Prologis right now. We own a lot of apartment REITs. And then there's kind of like a 20 to 30% allocated to what is kind of a little bit more quirky, where there's higher upside, but it's got a little bit more hair, what I would call more opportunistic. This could be like a nice illustration would be Mid America and Camden are both, they both cover their fixed costs 6 to 8 times. They have very little debt. Their loan to value is probably both under 25%. And there's another company called Next Point Residential, which has a lot of similar exposure. They were doing a lot of value add deals in the Sun Belt. And that's got probably 55% loan to value if you use like a private market cap rate for that portfolio rather than the enterprise value. And, the coverage ratio is not as high as Mid-America Camden. Now, I think that because of the higher leverage, there's more upside in Next Point. So like that would be like a very good illustrative example where if I were going to own 3 multifamily REITs, I would probably want to own Mid America and Camden, 40%, and then 20% in Next Point. Now I'm not saying like that's the entire portfolio. I'm saying like that would be an illustrative example of 70-80% kind of core, low leverage, to where I think that the forward returns are in, kind of like the mid to high teens IRR for the next 3-4 years with very, very low leverage, right? And then on the opportunistic side, I think we could target, call it, 20 to 35% IRRs, and sometimes even higher if you have investments that have some sort of like capital return where maybe they're selling like a large non-core asset and returning that capital to shareholder via dividends or share buybacks, right? So generally, that's kind of been where we've been. That's how we're thinking about the portfolio construction. Now, not everything is in multifamily right now. I mean, we find grocery anchor shopping centers to be interesting. Post GFC, there's just been such a low amount of construction in grocery anchor shopping centers. And for a really long time, people thought that Amazon was going to kill all these guys, right? But if you drive around, you realize, hey, Amazon bought Whole Foods for a reason, because they realized that delivering groceries is kind of it's kind of very uneconomical business model. So they, instead of trying to continue to compete with the local grocery store, they bought Whole Foods. And I think we're also realizing that there is just demand for very easy to drive to, park, and walk in locations, right? Whether that use is a pizza shop, your local bar, your Chinese takeout, your convenience stores, et cetera, or its use is some sort of medical treatment, like an urgent care, or like a yoga studio, those small format gyms, right? The specialty health and wellness locations. It doesn't take away that a lot of these locations are well located. They're on Main and Main. And if one tenant, if one tenant's use becomes obsolete, someone else wants it, right? There's been this like retailification of medicine and healthcare, where I'm sure you two have seen it, where a lot of these MRIs and these outpatient facilities are located in these, grocery anchor shopping centers, local strip malls, et cetera. So that's an asset class that we like. I think that asset class, because of the fear of the rise of Amazon and e-commerce, a lot of investors have generally written off those assets, and there's been very little supply addition. I think a lot of them are priced very reasonable. I think a lot of them are priced below replacement costs. And if anything, a lot of them kind of sit on large parcels, kind of like that Sears, narrative of this excess out parcels where they could develop and maybe convert some of it into multifamily. But I think that what's different is that a lot of these grocery anchor shopping centers are a lot healthier. And I've been very surprised by how many of those vacant spaces has been repurposed and taken up by, the next concept. Like if you look at the Burlingtons of the world, right? Like even some of the bigger boxes that has failed, like over time, they've been absorbed and a new tenant, a better retailer has taken them over. Dick's Sporting Goods, Burlington, your kind of off-price retailers like a TJ Maxx have taken up a lot of these spaces. We like grocery anchor shopping centers. I mean, late last year, we picked up some self-storage. I think, we love the self-storage business model. We have a mantra: never bet against the American consumer's propensity to hoard useless assets, right? It's tough. That's just something I don't want to bet against. And in a lot of dense populated areas like Brooklyn, there's very strong NIMBYism towards those asset types. This applies to warehouses as well. In a lot of densely populated areas, people want developers to build housing. They don't want more self-storage. and they don't want more warehouses, which make these very difficult to build in dense urban infill locations. So I think it's all valuation driven. It's probably unfortunately a lot of self storage trade at lower cap rates than the Sunbelt multifamily. Um, so we're more at the moment we're more inclined to have very very heavy allocation to a lot of the apartment REITs, and a little less to warehouses and self storage. But one thing that's really interesting about warehouses is that in a lot of dense urban locations, supply actually goes down over time. And if you kind of think about it, it kind of makes sense, right? Here in Brooklyn, Queens, a lot of warehouses were knocked down to build multifamily. And if you look at, there's a really good chart that I saw recently. Terreno Realty, I believe Terreno Realty is the one who published it. You see that over time in the last 20 years, the supply of warehouses in Washington, D.C. has actually gone down something like 20%. The supply in New York City has gone down, like somewhere between like 8 to 12% since 20 years ago. So it's incredible to invest in the real estate asset class where supply actually goes down over time instead of up, because that gives you a tremendous amount of pricing power to raise rent over time. And if anything, your product probably don't face any product obsolescence over time. So, I think I want to take a little breather and see if you guys have any feedback or questions.
Yeah, so it sounds to me like in general, high level, if you're thinking about which space you're most interested in, that it's actually multifamily in particular. And I was looking at a chart of Mid America apartment, and it's down by half since late 21, early 22. And it's down more than, I guess, some other REITs I see. So maybe can you help me unpack some of the dynamics, the degree to which this move reflects obviously higher cap rates, so the interest rate exposure, but also perhaps were there questions about like supply demand dynamics and overbuilding during the last few years that might have a hard time getting filled up? Perhaps are there some hidden liabilities here, despite a clean balance sheet, where they have commitments for new builds, where they have to spend this money, and it's less certain what it looks like over the coming years? Curious how you
Sure.
think about what drove the downside and why it should find some stability from here.
So that's a great question, Elliot. And this is just to further, further like the Missa market example. The way that I look at REIT investing and public real estate investing is that I truly take kind of the owner's approach. Like I think sometimes like people I think people sometimes say that, but they don't actually mean it. I personally think it's a little bit easier to do with real estate because it's not an AI chip manufacturer that can morph into something else, right? Like think about the corporate trajectory of NVIDIA, right? It was one thing, and then now it's become this AI pure play, right? It like what you think you owned 20 years ago is not what you own today. An
Painfully know
apartment
that.
building. What's that?
I painfully know that. You absolutely do not own Tegra and NVIDIA today.
Yeah, so I'm sorry for bringing that up, but I what I was trying to do is just like illustrate that if you own a Sunbelt apartment 20 years ago, you own a Sunbelt apartment today. Like very little has changed, right? I think what has changed is that a lot of Sunbelt cities have gained more density. I think they're better, the denser, the more vibrant cities today. Um, so this is like a very long way for me to like set up what I'm trying. The point that I'm really trying to make is that I approach real estate ownership in the public market like a private guy, like a kind of like a real estate family who's looking to own this for a long time, right? But the other market participants, I think they're very like in the moment, right? What is going on? What is the interest rate today? What is the spread of the what is the spread between the cap rate of mid America versus what the 10-year is yielding today? What is the current rent trends, right? So there was a period like, in 2021 before the Fed raised interest rates, Mid America was in essence like trading at somewhere between like a 3.5 to 4% cap rate, which I, and no one wanted to own any coastal, right? No one wanted to have any coastal exposure, which is anything that owns anything in New York City, and everyone thought that no one will want to live in New York City. New York City is dead forever, and so I think the market gets really caught up in the moment of like what is going on, what is happening right this moment, and so I think in 21 the market got really caught up in these are unbelievable rent stats, right? You're able while New York City and San Francisco and these dense coastal cities are losing population. Everyone's flooding to the Sun Belt, which created a shortage of housing for everyone. And they're 10, 15, 20%, 30% year over year rent increases. And there's less government regulation on how much you raise rents by. There were less protection for the tenants so that if someone wasn't paying, you could kind of, ask them to leave, which is not the case in California and New York, right? So people were absolutely in love with this asset class. All the Sunbelt multifamily REITs, traded to their peak valuation at that time. Fast forward to today, the narrative have totally shifted, right? The narrative is that as a response to all this immigration to the Sunbelt, and as a response to really low interest rates, the 10-year was literally 80 basis point at one point. When the 10-year is at 80 basis point, the development model is that if you could build to a 6% unlevered yield on your development project, and you could sell the newly constructed building at between 4% to 4.5% cap rate, and sometimes even like a 3.5 cap rate, a developer can make a lot of money, right? And guess what? Like capital cycle theory happened in real time. You have the biggest construction of multifamily in Sunbelt. Now, this is the biggest in history on absolute units. I went back and looked at the last time they built this many apartments. The thing is that it's not the biggest per capita. And what I mean by that is that there's something like 900,000 units of multifamily being built in the past couple years, right? And that is the absolute most under construction. The last time they had something that much was like 40, 50 years ago. But back then, the U.S. population was, I believe, somewhere in the 240 to 260 million versus like 330 million. So this is the biggest. This is the most amount of delivery, right? But it is not the most amount per capita. Now, so there's this huge overhand in the Sunbelt apartment narrative. Oh my God, this incredible amount of delivery is being delivered into the market, and it's got to cause rent to collapse and all these like really nasty things to happen. And as a value investor who's thinking as, okay, well, like if I could buy in at a 7% cap rate, you could have NOI drop 5, 10, 20%. Like I'm still getting in at a very, very attractive, cap rate. Like I'll take the pain. And one of the nice features of these REITs is that I do receive as of today, Mid-America pays a 4.3% dividend. So I could take that dividend and I could reinvest it in shares. Now it's not as, tax efficient, but it provides me with a mechanism to own more shares. And I literally sit I literally, the way that I think about it is that I just imagine myself, I get to buy an apartment building at roughly $200,000 per unit for mid-America. And every time I get a dividend check every year, right, I could buy 4% more apartments, 4.3% more apartments. And if this, as the stock price stays low here, I will just keep reinvesting that, right? So I think when you take a mental approach like that, it becomes a lot harder. I don't worry about the day-to-day, quarter-to-quarter, the short-term price gyrations and this worry. I've been doing this for 11 years on the public side. And the market is very, very focused on what is going on this year, what is going on in this moment. And it wasn't that long ago that the market was absolutely in love with the Sunbelt multifamily asset class. Another example, the other company I mentioned, Next Point Residential. At one point, Next Point Residential traded to $90 a share. You could buy shares for 35 today. Now it's more levered, right? It's more levered. It's got more debt on it. So that makes sense. But it really just goes to show you that in 2020, 2021, nobody wanted to own the coastal apartment REITs. And then within 2-3 years, it's gone from the narrative in the market has gone from no one's going to live in New York City anymore. Everyone's going to live in the Sun Belt, right? Crime is rampant in New York City too. Now you talk to any Southside REIT brokerage, they're going to say, stay away from the Sun Belt. There's delivery issues, this oversupply issue, blah blah blah, and like stick with the stick with the coastal. But obviously, there's a big delta in pricing. The coastal REITs are trading at generally in a low 5 cap rate, right? And you buy the Sun Belt closer to 7. Now, I think there's the coastal probably deserve to trade at a lower cap rate because they just have much better protection against new supply being added to the market. Like New York City is just almost near impossible to build new supply. So you always have that going for New York City. Now, how is a market absorbing all this new supply? Everyone was worried, and the data that we've been seeing is the market is in the first quarter of this year. The market, this is the most amount of absorption of new apartment supply in the Sun Belt, and everyone was worried about rent declines, excess concessions. Mid-America have come out and said that they expect same-store net operating income to be down 2.8% to, I guess, like maybe flattish. And Camden, is within that range. Like either most of these big Sunbelt apartment REITs are guiding that they're guiding to 2024 same-store NOI kind of between down 3% to plus like 1% in that range of all the ones that we track. So everyone's got this image of this Armageddon of like the most amount of supply hitting the market, and the public REITs, during the Q1 earnings call, just told us that they think same-store NOI is going to be between -3 to like +1 in that range. The coastal REITs are guiding to much better. They're generally guiding to like, I think like 3% growth in NOI. So now what's really interesting is we follow this very, very closely. I'm friends with a lot of multifamily developers on Twitter. And we get, they share a lot of thoughts, and they share, whether they're moving forward with a new construction project or not. And they're basically consistently saying that they can't make new construction pencil today. They can't justify starting new construction because if you're still kind of building to a 6% unlevered yield. But there's a huge difference if your construction financing costs 10% today instead of maybe 5 or 6% in the past. your material costs, your labor costs has stayed roughly the same. It's been very sticky. It hasn't come down, right? And the bank won't lend you as much. And the lever IR on the development project has, in essence, gone from low 20s to, by my estimate, 6-7%. There's we don't know of any LPs who's willing to cut a check to go finance a new construction. So Camden particularly has a really nice chart that shows this massive cratering of apartment starts that we're really happy to see that show up in the data because that's what we anticipated, and we're seeing that in real time. We're seeing it in the data that's being reported, but we're also hearing it anecdotally from all the real development GPs that we track that they can't, the financing, there's no capital appetite for new construction, and they can't get the IRs to pencil. So I think that a lot of the Sunbelt apartment, come call it like the second half of 2025, and like the other thing you got to think about is that you don't just snap a finger and build like hundreds of thousands of units, right? These things take time. From the moment that you get the go ahead to go buy a parcel of land, take it through like permitting and zoning, get the approval to finish construction, get it ready to lease, that's anywhere from call it 2.5 years to 4 years. So a lot of this supply, I think starting in 2025, you're going to start rent. I think a lot of the landlords will have better pricing power and better, more power to raise rent, and that will persist for at least 2.5 years by my estimate, because I'm just not tracking any new start. I'm not seeing people moving forward with starts. Now, ironically, the people who actually could move forward with new construction are the public REITs. They have the capital because they could they could finance everything from cash flow that they generate internally. Because remember, they pay out the dividends, but they're only paying out 2/3 of it in dividends. They're retaining another 1/3 of the free cash flow. So the public REITs actually are kind of the guy with the people with the players with the strongest hand in this market, in that they could access the capital markets. Both Camden and Mid-America issue 10-year fixed rate unsecured debt at 4.9 and 5% coupon earlier this year in January. So the capital markets are telling the blue chip apartment REITs, hey, we're open for business with you guys. They have healthy balance sheets where they could take the leverage higher. They could justify building new construction because they have access to capital, but they also retain some of the cash flow for developments. So it's really this like tale of two cities, right? Like it's a tale of two worlds where a lot of private guys, a lot of private GPs, what we've been hearing is some of the private GPs will tell the LPs, we're doing fine, we're doing fine, we're doing fine. And then like on the next report, they'll say, we're issuing a $5 or $10 million capital call and we need the money like within a week, right? There's clearly things are not well on a lot of private side, but on the public side, you know exactly what the balance sheet look like. You know exactly what the debt maturities are. You know exactly how much they're paying out. You know exactly what the coverage ratio on their interest payments are. So it's just no brainer that the public side, even though sentiments are absolutely poor right now, it is the area to be allocating capital to, in my opinion.
So, this is extremely thorough and has given me a lot to think about. I guess one of the other elements that I'd love to hear you explain about the Sun Belts, for years, the allure, and I think part of why Mid-American have been so successful is we've had this like massive population migration from the coastal like the big cities to the Sun
Mm-hmm.
Belt. And like
Mm-hmm.
during COVID, we'd hear about the Great Resignation and people, uh, the boomer generation retiring and sailing into the Sun Belt,
Mm-hmm.
so to speak. Um,
Mm-hmm.
do you track like population migration, and do you have any fear that perhaps we're on the wrong side of peak migratory flows into the Sun Belt areas, and that it might be tougher to start filling things from here?
So I'll talk about some positive and some negatives. We definitely track that migration very, very closely. And by the way, this is coming from someone who self proclaim like I jokingly proclaim myself like that snooty New Yorker, right? Who thinks that New York is the center of the universe. Like I do it in jest, right? Like I don't truly believe that, but like I kind of play up that caricature. Um, so my views on the Sun Belt have actually changed a little bit in the past few years. In that, uh, as us equity guys, like have also heard the phrase, right? Oh, equity sales in Dallas, right? Like it conjures up this image of Dallas is a place where your finance careers go to die, right? Like you can't make a living selling equities in Dallas. But what I've noticed, and this is where my analyst and I have spent a lot of time thinking about the migratory patterns and kind of the concept of cities and like how much critical mass do you need before like you have a real city, right? And no offense to like any other city out there, but there's very few cities in the U.S. like New York where you could like kind of like walk a half a mile and you like bypass 100-story office buildings and just like densely packed, right? There's very few cities like that in the US. But one thing that I have noticed about the Sun Belt is that it kind of started out like with JP Morgan, we're going to move our back office, right? Like we're going to move our back office to Salt Lake City. We're going to move our back office to Jacksonville, whatever it may be, right? And I think that if you were in the Sun Belt, you would generally consider kind of middle/back office. But I think that my views on some of those Sun Belt cities have changed over time because I saw what happened to Austin and how a lot of that San Francisco, that really high paying venture capital front office population have moved from San Francisco to Austin. You're also seeing it on the finance side with Ken Griffin deciding to build a 1 million square foot right on the water in Miami, right? And it's like, what is more of a barometer of like, what's a bigger stamp of approval than someone like Citadel, one of the most profitable hedge funds, right, deciding to build this global headquarter on the water in Miami, right? Where it like I looked at the starting pay of some of the analysts and associates at Citadel. Frankly, I was a little bit jealous because I never made that kind of money in my 20s. So I think that a lot of the Sunbelt cities, and if you look at a city like Austin, they've grown population by like we're talking about like 50% addition to population. I think Austin might have grown more than 100% actually since like 2011, which was the last time I was there. I think there's been a certain critical mass. I think when a city gets, a certain critical mass, it gets denser. Now it's got like it's a real city. It's a real city with an ecosystem, and it just like a lot. Cities has a way of attracting more residents just by the fact that it's a bigger city, right? There's more of a critical mass. Just kind of like the dessert game or the croissant game in New York City is on a different level, right? The dining in New York City is on a different level because in order for you to make it here, there's so much more competition. Unlike in Rochester, like I think like your game doesn't need to be at a very high level in Rochester. Shout out to Keith, right? To Keith Smith. But so I think that a lot has happened to these Sunbelt cities. I think they're denser today. They're more legitimate cities by like, the way that I would describe it from a career perspective. I think they're also more fitting for front office personnels rather than just let's move some of our middle office, back office. And I've also noticed just like some of the restaurant, food and beverage amenities have also dramatically improved in a lot of these cities. So we do track net migration patterns, and Miami, Charlotte, Nashville, like Austin, they're still taking in more new residents. I think I heard a stat that Charlotte has something like 15 or 30 people like moving to Charlotte, like some like every single day, right? There's just these cities continue to draw new population. And another thing about kind of real estate rent growth, and this is a memo that I wrote about, is that there's only so much land in any city. As you get denser, like your ability to raise rent is not linear, right? It's not this relationship between rent and population and kind of like the available land to build new supply. It is not a linear relationship. Oh, as population grows, rent goes up. Population grows like 2%. Rent goes up 2%. There's only so much land, and a lot of the GP developers have kind of openly complained that it's becoming harder to build in Texas. It's hard to build in Florida because labor costs got up, material costs got up, but land is just less available and more expensive. So all these factors and variables like plays into how I think about making the allocation like this in 2024, and why I think the large blue chip apartment REITs in the Sunbelt is some of the best bargains, right? Because I think we're in a moment right now. Some of the pushback I keep getting from people is there's generally like the hedge fund type who just says, well, it trades at a 7 cap. The 10-year yield is this, like it's a 230 basis point spread. It's not really that cheap historically. I think a lot of those tend to just think that you snap a finger, you could just build all the supply. It just comes out instantaneously. It doesn't really work like that, right? It really does not work like that. There's really long lead times to build supply. And then frankly, at a 7% cap rate, if the market price for these assets is 7% cap rate, no one's going to be building any new supply. So that eventually will translate into higher rent growth. It could be, I would probably put in 2025 and beyond, I would probably put rent growth at a minimal 3%. And I wouldn't be surprised if we wind up with, kind of like 5 to 7% rent growth annually, because supply is going to get tight again. So this is a very long-winded way of just going through and explaining all the different factors that we consider when we make this allocation. It's not just one thing. It's not just, oh, the spread is X basis points and it's cheap or not cheap. It's there's a lot of capital cycle theory in here that, hey, we buy it at a high enough absolute yield, but there's a supply picture, and there's a supply dynamic where they're not building supply, and these cities are frankly more vibrant, more resilient today, and continue to receive new net migration. Now, one thing I will admit to you is that since rent has gone up, I think some of the arbitrage between the coastals and some of the Sunbelts has shrunk, right? Like, I mean, there was a time where if you move from New York City down to Miami or to Austin, there was a huge delta in what you pay for rent in New York City versus what you pay in Miami and Austin. I think some of it has closed, but I think that if you factoring in the fact that you don't have to pay state income tax for in Texas and Florida, and you don't have to, you just get more bang for your buck from renting apartments and just overall cost being lower across the board. I think it's still very attractive, and the best proof of that is these cities continue to receive new residents.
Wonderful. Well, Bill, this has been so terrific. Hate to kind of end it here for this episode, but we are running out of time. We're going to definitely pick this up again if you're willing. I also have a bunch of questions, so hopefully we get a chance to reconnect real soon. I hope everyone listening enjoyed this, and hope to reconnect and dig deeper and cover some other topics related to real estate. So thanks both, Elliot and Bill. Really enjoyed it.
Thank you, John. Thank you, Elliot.
Yeah, thank you, guys.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.